All right, ladies and gentlemen, welcome to today's session here. Thanks for being here. My name is Rodrigo. I'm going to be here with you today. We have something very special planned for you folks there in the YouTube chat, in the Zoom chat. We got a lot of people together. Go ahead and let me know when you guys are ready to start and where you're tuning in from. All right. And today, we're going to be going over a special session that we have, Total Options Tuesday with Chris Capre, lead educator at Benzinga Option School. All right. He's the chief educator there. A lot of you guys already know him. He does the classes there, fully options, right? 100% options. So, and yes, that is correct. That is Chris Capre. All right, Memphis, Atlanta, California, UK. Let's go, guys. Let's go, guys. Thanks. All right, I think we got a good crowd here. Without further ado, let me go ahead and bring the mastermind here. Chris Capre, how are we doing, sir?
Very good. And yourself?
I'm doing good, man. I'm doing good. How was everything today over there at the option school?
It's good. We had some pretty good trade ideas from some of the members, and we got to go over the option Greeks today, which is a critical lesson if you are going to trade options. So a lot of juicy stuff, a lot of interesting information, and yeah, it's been a great session today.
Absolutely. I was able to just, be there in some of the sessions that were there today. It's really informative, very educational. You have a very teacher approach per se, like, no trader left behind. That fits so perfectly well here. Chris, I know that you have a presentation ready for today, special. Are we good to go with that?
Yeah, let me get the screen going here. Okay, you should be seeing that pretty soon. Let me know when you got it.
All right, I can see it. Folks in the chat, let Chris know.
Sweet. Put a 1 in the chat, by the way, for my Zoom attendees. If you can see the, it kind of looks like the thumbnail. It's just a bit. So let me know if you can see that. All right, love, appreciate it. Thank you. Thank you. Much appreciated. Okay. All right, let's go ahead and begin. So Total Options Tuesday, real briefly. We're going to be talking about Peloton, Disney, and AFRM. But before we do, there's something that is unique to all of these stocks and these tickers for this week. They all have earnings. Peloton already had earnings this morning, and Disney and AFRM are coming up. And so, we're going to be talking about earnings, using options to trade earnings. How do earnings affect the options market going into it? After that, ways we can trade it. We're going to spend a little bit of time diving into Peloton on the day, because that was the big earnings mover. And it's also had a little bit of a news around that. So we're going to be talking about that. So briefly before we jump into this may be your first time seeing me present live or hearing anything from me. So this is just a brief bio about my background. So I've been trading for over 2 decades professionally. I was a former broker on Wall Street. I did that for 2 years. I used to work on Wall Street, and then I helped to open up an office in San Francisco for the brokerage I work for, which is FXCM. It's an FX brokerage. And then after that, I got a job offer to work for a hedge fund. So I was trading for a hedge fund after that. And in both of those outfits, as I was going through the brokerage ranks and things like that, and as I was trading for the hedge fund, at some point along the way, they're like, hey, you seem really good at this. Do you want to also teach, some of the younger brokers some classes on this? And in the hedge fund, they're like, hey, you seem to understand this pretty well. Do you want to teach some of the new hedge fund trainees? And so I have been teaching since 2004, leading classes since 2004. So you're talking now, I'm going into my 18th year of teaching and now my 22nd year of trading. And so I've traded everything under the sun: stocks, options, commodities, crypto, bonds. I mean, everything you could possibly imagine, stocks from like 20 different markets and exchanges and countries all over the planet. I've traded it all. And, that has given me a vast amount of experience. And in trading, it's one of those environments where if you get caught up by the attention on YouTube, people flashing P&L signs and cars and stuff like that, it's easy to get distracted. But in trading, experience matters. It really does matter. And I think there's, just a lot of information out there that can be tricky for people to understand what's, good and not, and what's helpful and not. And, it helps to default to somebody who's had experience. Like in the last 22 years, I've gone through a market crash of some sort, literally almost every 2 years, from 9/11 to London terrorist bombings to the Swiss National Bank adjustment of the Swiss franc, the flash crash in the S&P 500, 2008, GFC, the great financial crisis, the COVID crisis. I've gone through it all. And that experience really makes a difference. And it was something that I learned very early on when I was a broker, because I was sitting around traders who were also incredibly experienced. One of the guys sitting next to me was a former 30-year bond trader. And that experience gives you certain insights into the markets that you're not going to get if you've only been trading for a few years. And so I'm just kind of communicating the fact that people that have a vast amount of experience tend to understand the markets in a slightly different way than maybe, some of these people that have been around for just a couple of years. So that's what I bring to you, is not just experience in trading, but also experience in teaching as well. I am also a verified profitable trader. We posted our results for 2020, and we're just compiling the last results of 2021, and we'll publish that shortly. Made money in 2021 as well. And so that I make money trading. It's not just that I'm teaching, I make money trading. And so we did about 72% return in 2020, and we did a little bit less in 2021. Most traders did less in 21. They did in 20. But so far, we're also off to a great start in 2022, which has been a challenging year for a lot of traders. I know a lot of traders that are struggling in their portfolios this year. S&P 500 down about 7%. A lot of single stocks are down 15 and 20%. And they're struggling because they haven't been able to kind of change their bias or their understanding of the markets quick enough in the last month. So we're going to talk about options and how it's a great vehicle to really do that, to deal with kind of hedging impacts, and if the market gets a little tricky, how to use that. And as it says here, I'm also the head of the Benzinga Option School. So we just recently launched the Benzinga Option School. We've already built several hundred members in it, and the reviews have been pretty awesome. We get live instruction 5 days a week. And we did the math that if you buy at the discounted price, you're literally paying like $2.10 an hour for like 50 weeks of instruction, 3 hours a day, Monday through Thursday. And then Fridays, you also get an hour instruction as well. So it's an absolutely phenomenal program. If I had had this class when I started trading options in the beginning, I probably would have saved myself well over six figures in just the time and energy and not making as many mistakes and having to learn it myself. So traders are just growing in leaps and bounds there. And, it's our hope that for those of you that really want to take your options trading to the next level, that you'll come join us. So with that being said, I'd like to go ahead and get into today's presentation, which is going to be talking about earnings. And then I'm going to be talking about many of the tickers that we talked about. We're going to be diving deep as we get into the presentation on Peloton. And then we're also going to be kind of digging into Disney and AFRM, which have their earnings coming up. So just want to shout out also to my YouTube viewers as well. I'm watching the comments live and everything like that. And so, yeah, I know there's about a 10, 15 second delay in YouTube. So I will keep an eye on that and make sure you all are, I'll answer your questions on that in Zoom as well. Okay, so let's get into it today. So in talking about opens or earnings, so we're going to talk about how to trade options and earnings with a focus on Peloton and then Disney and AFRM, which have theirs coming up. Now to trade earnings, the most basic thing is you have to understand option mechanics. How do the options market work? How does calls and puts work? What are the basic functions of options? And you have to understand how the Greeks works. Now, for all the people that are watching in YouTube and for all the people that are watching in Zoom, how many of you feel confident that you understand how calls and puts work? Put a 1 in the chat if you feel like you understand how calls and puts work, and put a 2 if you do not feel confident in understanding how calls and puts work. Okay. Mix, but more 1s than 2s, but definitely some 2s in there. Okay, cool. Awesome. 1 because of you. I appreciate it. 3. I didn't even know that was an answer. Does that mean you partially understand it? I'm curious. What does the 3 mean? Mike Gaskin, hello to you. Nancy says, Chris's option school is a must if you want to learn from the best. I appreciate that. Burns, good to see you, Burns. I dig it. Matthew says, I missed class today. I'm going to go look at the video. Copy that. And Drew wants to know, why did Peloton rip 395% today? We're going to talk about Peloton deep into detail once we get into this here. So, and Chica Blue, you're here. Good to see you, Chica Blue. Appreciate it. Good to see everybody here. Okay. All right. So the majority of people did answer one, but there are some twos. So let's briefly just talk about calls and puts. So just so I feel like the twos can feel like they have a decent understanding. So calls and puts are the basic building blocks of all options. This is something we teach in the Benzinga Option School. We have a whole lesson really centered around the basic mechanics of options and how the options market works. Now, there's a simple definition and there's a more complicated definition. And I'm going to go with the simple definition. So when you trade options, you're trading a contract, and that contract is on the underlying. And the underlying is either a stock or an ETF or an index or something like that. So you're not actually trading, when you trade options, you're not actually trading, say, like Apple stock directly. You're trading a contract which is connected to Apple stock. It's a derivative of the shares. So it's what we call the shares are the underlying, and an option contract is the derivative of that particular underlying that you're trading. Now, calls and puts are the most basic building blocks you can trade in terms of options. And all option strategies are simply a combination of calls and puts, or any combination in between. Some calls, some puts and calls, various numbers, amounts, ratios, and things like that, different strikes, different expiries. All of these strategies that you trade are going to be combinations of calls and puts. So these calls and puts are the basic building blocks that you trade when you trade options. Now, the simple definition that I would use for options or calls and puts would be this. And this is not the traditional definition, but I think it's a good way to understand it. So a call is God, that's really tiny. I wonder if I could change that. Could I change that? Maybe not. Is a contract that gains in value if the stock goes up and loses value if the stock goes down. Okay? So this is a call contract. It is a contract that goes up in value if the stock goes up in price, and if the stock goes down in price, then it loses value. A put is simply the opposite of that. A put is a contract, and I will delete this here. Oh, I didn't mean to do that. A put is simply a contract that goes up in value if the stock goes down, and goes down in value if the stock goes up. So based on that definition, we can surmise that calls as a whole for option contracts tend to be express more bullish views on the market because they go up in value if the stock goes up. They move with the stock. So if the stock goes up, they make money. If the stock goes down, they lose money. So really, if they make money if they're going up, you are trading a contract on the stock that will make money if the stock goes up in value. A put is much more of a bearish stance or contract on the market. It's basically saying, hey, if the stock goes down in value, this put that we buy will gain in value. If I buy that put and the stock goes down, that put that I own is now worth more than it was when I paid for it. So those are calls and puts. Now that's a simple definition. I could give the complicated definition, but that could lead to a lot of different conversations and questions about it. And I'd like to save that for another time because we could spend another 20, 30 minutes explaining the nitty-gritty details of that. So that is the basics of calls and puts in terms of contracts. And they allow you, if you want to change your contract for long shares, to buy a stock. Calls allow you to buy a stock at a particular price, and puts allow you to sell a stock at a particular price if you want to. So is there any questions on that before we move on about the basics of calls and puts? Who would you recommend as a broker for options trading? That will depend upon your country that you're in, Matthew. But we trade with my recommended broker is Thinkorswim. If I had to pick two other alternatives, then Thinkorswim is with TD Ameritrade. If I had to pick two other alternatives, Tastyworks and Interactive Brokers. Okay, so for those of you who put a 2, put a 1 in the chat if you feel like you understand that, and put a 2 if you feel like you don't. And if you don't, put your 2 and ask your question to go with it. Okay, mostly 1s across the board. Okay, sweet. All right, great. And I just want to give a second to my YouTube people because I know there's a few second delay. Okay. Okay, copy that. It looks like everybody feels like they got the gist of it. Okay, great. All right, so we understand the basic mechanics of calls and puts, how they gain in value or lose value. And there's also these things in options that kind of make options a little more complex than just buying and selling stocks. And there's things that they call the Greeks. These Greeks are basically variables that affect the pricing of your option contract. So there are various Greeks that you might have heard if you trade options, like delta and gamma and theta. And all of those are just individual variables that affect the pricing of options, the pricing of your options, the pricing of all options. And so if you think about it, like for example, and I use this reference a lot for my Benzinga Option School members, but I like to ski and snowboard. I live in the mountains near Lake Tahoe. And so for me, understanding when I go to ski or snowboard on any given day, I want to know what the conditions are on the mountain. I need to know, do I need to dress warm? Do I need to dress light? Is the snow going to be soft? Is the snow going to be hard? All these conditions matter because they change the experience of skiing and snowboarding. And there are many variables that can affect the condition of the snow. Is the sun shining on the mountain or is it shaded? Is there a lot of wind or is it quiet? Is there a lot of powder or is there a lot of hard packed snow? All of those are different variables that affect the experience of me skiing and snowboarding. The Greeks are exactly that. They are variables that affect the options pricing. Now, we're not going to do a lesson really on Greeks because that's a really complex lesson. And we could spend 2 hours on that and we would still have hours and hours to go on that. But just understand that if you are going to trade options and you're going to trade earnings, you have to understand how the Greeks work because these are some of the primary variables that will determine whether you make money or lose money. With options, you don't just make money on direction. You can make or lose money based upon time. You can make or lose money based upon volatility. There are many different things that can actually influence your option making money or losing money. And one of those things happens to be the Greeks. So are there any questions on this before we move on? Can you go over time decay and how it affects calls and puts? We will go into that, yes, particularly when talking about Peloton and earnings as well. Yes, we will get into that in a little bit for sure. For sure. That has to do with the Greek theta. Okay, put a 1 in the chat if there are no questions and put a 2 in the chat if you have a question and then ask your question with the 2. Billy MHC, is it hard or soft? I think you're talking about the snow. It matters. If you want speed, you want the snow to be hard. If you want a softer experience and you really enjoy powder and off-piste skiing, you want a lot of powder, not a little bit. It all matters. Isaac says too, some bio about the Greeks. Some bio. I think what you're asking is a little more clarification on the Greeks. If you can help me on that, Isaac, if that's what you're asking, let me know. Ray Ramirez says, any future live stream about the Greeks? Possibly. Yeah, possibly. We have a whole lesson on the Greeks in the Benzinga Option School. It's something we spend like literally 2 hours every 2 weeks studying and learning and then going into deeper on that. And then every options trade that we take, that we either share a live trade idea or our members have a live trade idea, we analyze all the Greeks in detail. So maybe in the future, possibly. Okay, mostly ones across the board. Where can I find more information about the Greeks? You can Google it, delta, gamma, and theta. There's a lot of There's a lot of stuff on that. Yeah. I don't want to spend that much time on it because of the fact that if we start getting into the Greeks, for the most part, it's going to be a 2-hour rabbit hole, and we're going to miss talking about Peloton and earnings and all these other strategies. Yeah. Samar, save your question. Let's get to that question when we get into earnings. Because we'll get into that. We'll get into that shortly. I don't want to dive too deep into it right now, but we will get into a little bit of that. So save the question for sure. Okay. So if you are going to trade options and you're going to trade earnings, you have to understand the mechanics. You have to understand the Greeks. You also have to understand how volatility affects the pricing of options. How volatile a stock is matters. If you think about it like this, if you are, say, a sports bettor, let's say you bet on what the most of the world calls football, in America they call soccer. Let's say you're sports betting on some football games or some soccer games. If both teams that are playing are teams that tend to score a lot of goals per game, like 3-4 goals per game, then there's a wide range of outcomes that can happen. There's a lot of goals. So, if you were to pick the final score, it might be tough because each one can score 3 to 4 goals, which means that there's a lot of different scores that could end up being the final score. That is a lot of volatility. That means there's a lot of possibilities on how this match could end. But if you take that and kind of reverse it or invert it, if the two teams that are playing historically barely ever scores a goal, max 2 in a game, well, that has less outcomes in terms of the final score, less potential outcomes. And so that is what we call lesser volatility. Volatility is important because how little or how volatile a stock is determines whether the stock will close at a particular price. So if I kind of draw this in a sense of like, if this is a stock price, and let's say this is low volatility and this is high volatility, let's say the stock price is at 150. A low volatility scenario for a day means maybe the stock moves up to like 153 and maybe down to 147. That would be like a low volatility stock. But if you take another volatility stock that's really high, maybe it can move up to like 160 in a day or down to 140. Because this has a higher degree of volatility, there's a higher range of outcomes in where that stock can close on the day. And that makes it harder to decide where is the stock going to close on the day. Because it's harder, when option contracts are being made, they use volatility as a variable to determine how expensive or how cheap that stock is. The more volatile it is, the more expensive the option tends to be because there's a greater range of outcomes. So whoever's selling the option contract has more risk because it could land at 160, it could land at 140, or anything in between. So if I'm selling the option contract, well, I have a lot more range of possibilities. So therefore, I need more money for selling that option contract. And so stocks that are more volatile have more expensive options. Whereas if a stock is less volatile, well, then I don't have to worry about it closing at 160 or closing 140. That's not going to happen. So I can sell these options for cheaper because of the fact there's less risk involved. There's less range of prices that the stock can close. So volatility matters. Volatility is like a Greek. In fact, there is a Greek that's actually tied to volatility. It's a second order Greek. I'm not going to talk about it today, but volatility is a variable that affects the pricing of options. Let's see if there's any questions on this before we move on. So any questions on that, put a 1 in the chat if there's no questions, and put a 2 if there is. Saeed, good to see you. Saeed's in our class. Good to see you. Matthew Pettyjohn says, I blew up a $15,000 account when I first started trade options because of IV crush, implied volatility, and a couple of bad plays. Yeah, it's one of those variables that if you don't understand it, you're going to lose a lot of money. You could make a lot of money if you happen to get it right, but if you get it wrong, you can lose a lot of money just because the volatility changes massively. That's why you have to learn about volatility before you start trading options. Bobby G has a question. Does your course cover advanced strategies in depth as well? What is the best option screeners available in the market? Yes, we do cover advanced strategies as well. We don't just go over basic strategies. We cover 10, we cover over like 20 different strategies in the course. And as the students get more and more advanced, we start going into more and more advanced options. There are enough advanced strategies out there that most people will never use them in their lifetime. And we'll just keep going deeper and deeper into them. But yes, we cover all that. Okay, any last questions on this? Put a 5 in the chat if there are no questions on this. Burns says 1. Kim Possible, good to see you. Gary R, another student. Nice to see all the students in the class. I have somebody in the Zoom who's posting in the Q&A. That's Mike Harrigan Mike. Mike, if you could do me a favor. So I already have 4 screens. I have my PowerPoint. I have my apps. I have the live YouTube. I have the Zoom and all this and that. If you could do me a favor and post your questions in the chat, for all my Zoom people, post your questions in the chat. It just means I have less boxes to go over and look at in a given day. So Mike, if you could do that, that would be appreciated. All right, 5s across the board. I appreciate it. And it's Tess. Good to see you, Tess. Hi. Okay, it looks like everybody's got that part about volatility. Okay, great. Okay, so we're going to be talking about if you're going to trade options and earnings, you need to know how earnings affect options. What are the typical effects that happen with options going into the earnings? And then what are the typical effects after earnings that happen with options? These are very important. If you don't understand that, you could get into a situation like Matthew Pettyjohn is, and you lose a lot of money because of IV crush. That's a terminology that happens with after earnings. So if you don't understand that, you're going to make mistakes and you're going to lose a lot of money. Okay. All right. Saeed says, I'm in his class. I did not know, I knew nothing about options. I am starting to learn a lot from him. I appreciate that, Saeed. You've only been with us a few days and you're definitely progressing really fast. So I'm super impressed with that. Okay. Now, there's a couple other things you're going to need to learn if you're going to trade options and earnings. There are certain pricing discrepancies and directions that tend to manifest with options. And you have to understand that. So we're going to talk about that, how that tends to play out. What do I mean by pricing discrepancies? We're going to talk about that. So we're going to get into that when we dive into Peloton. And there are very common earnings trading mistakes that you will want to avoid. We are also going to get to that in today's presentation. Bobby G, let's save your question for a little bit later because it's not quite tied to the material we have right now. So let's save that for an open Q&A in a little bit. Okay. So with that being said, let's talk about Greeks just real briefly. And we will talk about Peloton in this particular situation. And we're talking about, so we've talked about how the Greeks are variables that affect pricing. I feel like you all got that. Here's one of them, delta right here. Are there variables to Greeks? Yes. Those are what we call second order Greeks. So delta is a primary Greek. It's a Greek that affects the pricing of the options. Well, if you thought that was complex enough, there are actually other variables that affect the primary Greeks. So you have the option price, and then you have these Greeks like delta that influence the option price. And then we have Greeks that actually affect the delta. So we have multiple variables that are affecting the options pricing. This is why I think a lot of people don't trade options, is because of the complexity. But the complexity actually becomes your friend when you learn to use it in the right way. And on top of it, once you really start to learn how to use it, you actually can start to use these Greeks to find trading opportunities that you won't find if you're just looking at the charts and just looking at the news. So the Greeks are complexity. They're kind of like this barrier to entry. But once you get past that barrier, you start to see more trade opportunities than you would if you were just buying and selling stocks. So super important. Jaro says, can we get a recording of the session? Yes, it'll be made available on YouTube later, for sure. We've talked about volatility and pricing. We're going to talk about dislocations and opportunities. Okay, so let's get into, let's go through this slide real quick. and then let's get into Peloton, which just had earnings, and let's start to talk about that. So price action before earnings. How is the price tending to move before earnings? You generally tend to see, a couple scenarios. Sometimes, you can see a third scenario, but you tend to generally see a couple scenarios. Usually, like if this is the earnings date and we have like a few days before, there are often times where the stock can start to build up leading into earnings because there is an expectation that the earnings is going to be very good and that the stock will start to skyrocket after the earnings. Like they're going to beat on earnings, they're going to beat on revenue, sales is going to be good, forward guidance is going to be good. So in anticipation of that, traders are often buying shares in the days leading up to it. And so sometimes, and a lot of times, this kind of price action getting bullish into the earnings sets up an expectation for the earnings. That can create an opportunity because if the expectations don't come out as expected, a lot of traders are already long the shares. So the earnings come out and they miss and the stock tanks. That is a common experience. There is also, kind of a situation where traders aren't quite sure where the earnings are going to land up. And so you often see sometimes, like price was really volatile and then it starts to get really quiet leading into earnings. That generally means that traders aren't really sure what's going to happen on this earnings day. They're not sure if it's going to be a bullish earnings or bearish earnings. And so they're cutting back positions in anticipation of an earnings that they just don't know how it's going to land. They're not confident. Maybe the stock hasn't beat their earnings in 4 quarters. If a stock hasn't beat earnings and it's had a lot of mixed, that tends to create a lot of mixed sentiment going into earnings. But if a stock traditionally has beat earnings the last 4 quarters and nothing new has come out for that stock that would kind of derail their business, well, then you usually start to see that bullish price action leading into it. They've beat earnings before, they've been consistent, business has been good. We're expecting this to continue on in the future. So this is kind of some of the scenarios you will see. Sometimes you will get the price action declining into earnings, and that would represent that people are expecting the earnings to be bearish. So either they're already long shares and they're cutting their positions going into earnings, or they're shorting shares because they're expecting the earnings to come out and they expect the stock to have a bad earnings and take even further. So this is some of the common price action areas that happens leading up to earnings. Any questions on this before we move on? Put a 1 in the chat if there are no questions, and put a 2 in the chat if there is. And if there is, post your question. Roxanne, I am loving the option school just because Chris is a really good instructor. I really appreciate that, Rox. Thank you. It's good to hear. D Bangiev 90. Can you do options on GUU? If we have time for open Q&A, yeah, we'll definitely get to that. Toronto the Great says you can see it in EXPE, which just has earnings on February 10th. Yeah, for sure. For sure. Robert, Tampa Bay Buccaneers. Man, that was a heartbreaking way for them to end their season. That was a tough loss to see. You could have a buy it offer from either Apple or Amazon. Sure. Yeah, that definitely helped for sure. Is it not hard to capture that timing early? This is not like a crapshoot. So you're basically asking, hey, how can we trade before earnings? I actually don't make a lot of trades before earnings. Like if this is earnings and we're like a day or two before, I generally do not make many trades on that stock before. I actually usually wait for the earnings and then make trades after, because I think there are opportunities there, not just with the direction, but also fading the direction after the earnings. I think there are opportunities, and we're going to get into that. I think the better plays are actually before or after the earnings, not before, because before there's so much event risk, and there's other things about options that actually change the pricing of options leading into the earnings and then changes after the earnings, such as an Ivy crush, which we'll explain in a little bit. Evelyn Emerson said, I saw thousands of calls on Facebook or day of earnings. Why were 80% of the options wrong? That's a good question. I don't know. I wasn't asking those people why they were making that many options trade. It's generally common to see for a stock that has been doing okay up to that point, more calls than puts. It doesn't really matter if why 80% of the options were wrong leading into the earnings. What matters is how do you trade it after that? And if 80% are wrong, what's going to be the impact of that? So if you think about that, if you think about, like, say, Facebook, let's pull up a chart real quick. And these are things that we cover in the Benzinga Option School a lot. But in Facebook, you had, this is the typical scenario. Traders were expecting a strong earnings going into it. And then the earnings were shocked. And then some of the additional comments about forward guidance, in other words, how were forward sales the next quarter going on going to be affected? So they said, hey, we got worries about the new Apple iOS. That means that we can't track user data. That's going to affect their ad revenue massively. So in terms of why 80% are wrong, that doesn't really matter to me at all. I don't really care about that. What I care about is, does that create an opportunity for me? And so if 80% were wrong, let's just say this candle represents the total number of traders, option traders. Okay, if 80% are wrong, then that means, like, these people got it right and these people got it wrong. And if they were wrong, it means they had calls. They were long calls. And to denote long calls, what we use on the Benzinga option court is we put a plus C. That means they're buying calls. If they're selling calls, we put a minus C. So let's say you have a lot of traders who are long calls going into the earnings. And then you have a few people that are short calls. So that actually would be bearish. They're short calls or maybe they're long puts. It doesn't really matter. If there was 1 million options, let's say there was 1 million options on Facebook leading into earnings, and 80% of them were long calls, which are bullish bets on Facebook. Well, what happens when they find out they're wrong? They're going to exit out of the market really, really fast. And if the calls, if they had been buying them on this day or this day or this day or any of the days before that, then that means the calls were building going into the event. So the overall positioning was net long calls. And if the net positioning is long calls and the earnings come out bad and they're wrong, all those long call traders are going to rush out of the market. So what does that do? It takes the support out of the market and the market collapses. There's nobody wanted to be long calls after that announcement. And so what happens with Facebook after that? It just sells off and further and further and further and further and further. So that's one of the implications. I personally do not care if they're long calls or short calls. That's an opportunity for me.
Hey, Chris, really quick.
Yes.
Getting a lot of questions and emails here about the Benzinga Option School. Don't want to take too much time out of the
Sure.
lesson. Just want to get these questions out of the way.
Yeah.
So yes, that is correct. We do have a Benzinga Option School. Chris Capre is the instructor. Classes are there Monday to Friday, starting at 10 a.m. Eastern. Maybe we can go over the syllabus later down the presentation. But basically, yes, you will have access to the education, the live classes with Chris, his trading chat room as well. And you also get access to Benzinga Pro. So it is for the full year. I'm putting the link below, guys. It has a 70% off. And any questions, I'll put my contact so that you can reach out to me and we can try to, make the most out of Chris's presentation here today. Thanks, Chris.
I appreciate that, Rodrigo. And yeah, so
Want
what
to
we'll
add
do
anything?
is,
Yeah, if you want to add anything.
yeah, no, in terms of that, I'm thinking what we should do is we should go through the Peloton thing that happened. And then once we kind of digest that and break it down and how I traded after the earnings and everything like that, then I'll take a brief moment to explain the syllabus, how the course works, and how, what are the features of the course. Honestly, I think it's one of the most ridiculous deals possible. If the only thing that came with it was the live instruction, you are paying for, it's 50 weeks. I take 2 weeks of vacation off a year. So you're paying for 50 weeks, Monday through Thursday, you get 3 hours of classes. So it's 3 hours of classes. That's 150 hours. Okay. Right then and there. But then on top of it, we have 50 weeks of 1 hour. We have classes on Friday. That's 1 hour. So you get 200 hours of live instruction. And for that price, the course is ridiculously cheap. So 50 weeks times, sorry, what is it? The math is like this: 50 weeks times 3 hours, 4 days a week. So that'd be 4 times 3 hours a day. You get 600 hours of live instruction, not including the Fridays as well, which is another hour. So you actually get 650 hours of live instruction for a year. That basically breaks down to about $2 an hour. Find me a place on the planet where you can get live instruction from a 20-year professional for $2 an hour. Doesn't exist. If I'd had this 22 years ago, I would have gladly paid for this. If I could have taken this class 20 years ago, I'd be a centimillionaire today. I just have to settle for being a millionaire instead. So yeah, worth it. We'll talk about that in a little bit. Okay. And do you get the recordings of the 600 hours? Yes. All classes are recorded. You have access to all the recordings. Yes, absolutely. A couple questions on this before we move on. Stefan says, is it best to just let a professional from TD Ameritrade handle your option trades if you're not completely knowledgeable? No, because you have no idea. First off, you'd have to pay them for it. So that means all the money that they make, you're going to have to get, they have to take a percentage of it. Also, you don't know what kind of decisions they'll make. I prefer to be empowered and learn the skills myself than to let somebody else do that, because the skill can last me a lifetime. So I mean, if I had paid people to manage my account, I would not have made 72% in 2020. Not happening. Most professionals are making maybe 20, 30%. A good year is 30%. I would never have a 72% year. Just not going to happen. You can do a lot more on your own and you get to keep all the money. It's a no-brainer. For like 6 months to a year instruction, you can start making money easily. The access only lasts for 1 year. That's correct. That's correct. Chris K says he goes over the 3 hours, so a lot of extra. I do happen to go over my 3 hours a lot. Sometimes you do 3.5 to 4 hours of lessons. It's kind of crazy. Yeah. The school is way underpriced. I'm glad to know, Nancy. Does that mean you'll pay more for it? I like the videos that you can go through inch by inch later. I know it helps. It helps a lot. We'll talk about Peloton very shortly. We just got to get through a few other things, clinging game, and then we'll get to it. Okay. And Mike, Harrigan, Mike, if you can also, please post your question in the chat if you can. That'd be great. Okay. Ooh, this is an interesting question. Lev Currison says, curious, do we trade during the classes since it's during trading hours? No, well, I wouldn't recommend it. It's hard to take a class and make a bunch of trading decisions at the same time. If you're trading, you want to be paying attention to trading. If you're taking a class, you want to be paying attention to the class. If you split your attention, you will trade improperly and you'll learn improperly. That to me doesn't seem like a good idea. So if you feel like, hey, I have to trade for those 2 hours of the morning class, then just watch the recording later. But my recommendation is to train first, especially if you are already not making money. Why would you keep trading if you're not making money? Why wouldn't you use that to learn so that you can make money when you trade? So yeah. Bobby G, you have to ask Rodrigo on that. That's a good question. Smarter, not harder. Can you do options with a 3K account? Yes, absolutely. Yes, you can. You can even do it with a 1K account. Okay, sweet. Richard Judge, good to see you. Hello, good sir. Okay, so we've talked about price action before the earnings. Let's talk about volatility. Let's talk about price action after the earnings and volatility after earnings. And then after that, we're going to get into Peloton. So volatility before the earnings, it's kind of an interesting conundrum because there are certain situations we talked about where the market doesn't move much going into the actual earnings date. And yet the volatility, or the main variable that affects the pricing in options, is called implied volatility. And we write IV for short. So the implied volatility going into earnings tends to increase. Why? Because there is event risk on an earnings date. We don't know how the earnings are going to come out. They could be bullish. They could be bearish. They could be a miss with bullish news at the end of it. They could be really good, but hey, we're worried about this next quarter or something like that. There's a lot of potential for outcomes there. We don't know how the earnings is going to play itself out. And so because of that, the implied volatility, which is really just a measure of what the current spot price is looking ahead about 30 days. And so it's saying, hey, based on the price right now, what's the potential volatility looking in the future? And since we got earnings coming up, there's an event risk. We don't know how it's going to go. So implied volatility tends to go up leading into earnings, which makes the contracts more expensive. Now, you might have heard the term IV crush. The reason being is this. So IV goes up into earnings. This is the earnings date. And this is the IV. So the IV is going up due to the event risk of the earnings. And usually what happens is after the earnings, the implied volatility sells off. It sells off because now what was not known is now known. We know, did they beat on earnings and revenue? Did they miss? Are they confident looking forward? Are they increasing their forward guidance looking forward? Are they bearish going forward? We now know what their projections are going forward. We know what they did last quarter, and now we know what they're expecting going forward. That creates more knowledge and certainty. And so because implied volatility has been building up to this, implied volatility usually sells off massively. The thing about it is that if you're long calls, that's good leading into the earnings because implied volatility makes those calls worth more. But the problem is if you hold them after earnings and the stock goes absolutely nowhere, well, you're not making money on direction because the stock's going nowhere, but the implied volatility is going down. So even though the stock price goes nowhere, the implied volatility goes down, that lowers the price of the calls. Why? Because volatility is one of the variables that affects the option price. And so because of that, we have this thing called IV crush. And like Mr. Matthew said, hey, I lost 15K because of that. He was probably long calls. If I had to speculate, I'm guessing he was probably long calls going in earnings, probably had a lot of calls. Those calls were gaining in value going in earnings. Maybe the news was bullish. Maybe the stock went up, or maybe the stock went sideways. But because the implied volatility was elevated, it now came down massively. And those calls started to lose money in value. And so he lost money because of that. It's important to understand how volatility works before earnings and how it works after earnings. It tends to come down. So generally, leading into earnings, you want to be long volatility going into earnings. If this is the earnings, you want to be long vol going into earnings. Generally, after earnings, you want to be short volatility because that volatility tends to come down. That is very, very common. This is very, very important for you to understand that. Because if you start trading options before or after earnings, you might be right or wrong on direction. But if you're wrong on volatility, you're going to lose a lot of money, as Matthew attested to that. So it's super, super important. So we've covered volatility after earnings, and we've covered volatility before the earnings. One last point I want to make in this, and I want to take a few questions on this, which is that volatility, let's just kind of use a random example. Let's say volatility the week before. So we got 5 days of trading. Let's say earnings is on a Friday. And here's the earnings day. Volatility has skyrocketed. You know, whatever it was, it skyrocketed. It's really high. After earnings, volatility generally sells off massively. So we call this IV crush. Now, for those of you that feel like you have a pretty decent understanding of options, how many of you think that the IV tends to collapse the majority of gains just after the earnings, within the first day after the earnings? Put a 1 in the chat if you think that the majority of IV collapses the first day after earnings. Put a 2 in the chat if you think it takes a few days. So what are your answers on this? Lots of 1s. Lisa Gann says a few days. Some 2s. Okay. Okay. Depends upon the expiry. That's a good point. That's a good point. That's one of the better answers, Andy. That's not bad at all. Yeah, that's probably the most sophisticated answer. So yes, it does depend upon expiry, which we can maybe, if we have time, we can explain later. Less than 1 hour. Wow, that's bold. Evelyn, that's bold. Okay, my YouTube people are just chiming in. Some says no clue, some says 1. While a big chunk tends to roll off after the earnings, it generally takes several days for the volatility to normalize. So if volatility was, say, normal 1 week out, and let's say implied volatility was at 30%, and then implied volatility got up to like 60% by the earnings date, while you will see a good chunk of this roll off just after earnings, it generally takes several days for volatility to normalize back to 30%. If 30% is, say, normal for that stock, it generally does not go from, say, 60 to 30 in 1 day. That is not common. And so maybe you miss being short volatility on earnings. Well, volatility tends to keep lowering down. The higher volatility goes away from, let's say, its normal baseline, the longer it takes generally to renormalize. Very rarely does implied volatility fully normalize within the first session after earnings. So if the earnings releases before market, by the end of that session, very rarely has implied volatility normalized back to baseline. It usually takes several days. If it's, gone up really high, then it takes longer to normalize. So that means that if you understand that, that means that generally short volatility tends to work for a couple days, not just 1 day. Just because you missed, like if earnings came out this morning before market, just because you missed the open on the market to short volatility doesn't mean that you've missed the entire trade. There's still a lot more trade in terms of short volatility out there. Okay, so any questions on this before we move on? The most sophisticated answer is it depends upon the expiry to some degree, whether we have short or long expiries. That does make a difference, but that requires us to get into a lot more nuance about volatility and expiry premiums and everything like that. Okay, so we are getting some questions. Chris Gaskins has a question. When you talk about Disney, can you make some comments about what the IV is and what do you expect it to be as we approach tomorrow PM earnings? Sure, we can take a look at that for sure. I honestly don't know what I expect it to be. I don't make predictions on what I think the IV will be. To me, that's a very difficult, thing, especially if it's an after hours, if it's like an aftermarket earnings release. It's hard because a lot of things can happen over the session. So I don't try and predict what the IV will be. I more of just watch it and then decide, hey, is the surf breaking left or right? That's the way I want to go, so to say. Dan Super DL Ninja. Is it better to sell options during earnings? We're going to get into that for sure. It depends on this particular situation, but if volatility has kind of overshot its baseline and there's nothing in the earnings that's going to keep the volatility elevated, then the answer is yes, generally you want to short volatility, which means if you sell options, you're short volatility. Chris Gaskins has a question. Does each option chain have a different IV or just the stock? Or every stock has its own implied volatility. And the implied volatility is going to change across all the strikes and across all the expiries. So it's not constant. It's not fixed. It's always in flux. Tesla is going to have different implied volatility levels than Home Depot. GME and AMC are going to have different implied volatility levels than Best Buy. So each one is different. The key is to learn the stock enough to understand what is normal for that stock and what is abnormal. Let's see here, a couple questions from my YouTube. Let's see here. Do I recommend futures trading? That depends if you really have a fancy for it. Otherwise, I prefer trading stocks and options. Smart or not, however, what's the level of the options course? Does it start with word definitions, meaning for low to zero options? We start from beginner and then we work our way up to more and more advanced lessons. So yeah, it starts at the kind of the base foundation that everybody can understand. The first lesson is just a basic introduction to options. It starts from ground zero and we slowly work up the option difficulty. So yes. Toronto the Great, does it sell off massively even if it has positive? Possibly, that can happen. If there was a massive expectations for the earnings release and the earnings is still positive but not as good as traders had anticipated, well, maybe they were thinking it was going to be over bullish and it didn't come out that way. So yeah, that can happen for sure. Absolutely. What about if you hold puts? Can you give me more clarification on that, Peter? I'm not understanding about holding puts before or after earnings. If you can give me a little more detail, that would really help. Toronto says, can we dissect Amazon? Possibly if we have time for that, yes. Would it be wise to sell as they're announcing and go back once it settles? That will depend upon the options you have leading into earnings. Yeah, that would depend. It depends on how much profit you're in. You know, what's the risk to reward at that point? Like, let's say your traditional option trade makes a 2R return. So if you buy an option for $1.50, you tend to walk away with, you know, a 2R, 2 times your risk on that. Okay. Well, if you're in an option trade that's now up like 10R, 12R, and that's statistically outside your norm, generally you would want to close that trade. So it depends upon you and it depends upon how your option is doing in relationship going into the earnings. I generally do not hold trades through earnings unless I'm like really confident and there's very little minimal risk to me at that point. If I'm in a trade and I'm up a fair amount of profit going into earnings, I generally just close it because I'm kind of rolling the dice at that point. Before the earnings, I know I can lock in a certain amount of profit. During earnings, I am rolling the dice. It could tank and I can lose on a winning trade just because I held for 1 extra minute through the earnings. So yeah, I tend not to hold through earnings. Okay, Casey has a question. Do you short volatility by shorting the stock? No, when you trade stock, you are even on volatility and you're even on deltas. If you want to short volatility, you would sell options or you would sell option strategies that make money if the volatility comes down. There are very specific strategies for that. Peter Ivanov says, is Ivy Crush also affect you if you hold puts before earnings? Yes, absolutely. Absolutely. It goes both ways. Implied volatility affects the pricing of all options, calls or puts. Can your broker manipulate the volatility? No, that's not what their business model is. Generally, broker's business model is not to manipulate volatility. A broker has a very good business model. They match buyers and sellers. They do that. They collect a piece of every single transaction. They don't care whether the market goes up or down. They have a way to make money in the market without having risk to the stock going up or down. Now, if you had that business opportunity, would you take it? If you had a way to make money from the market without caring whether the market goes up or down, and you're just bringing buyers and sellers together, wouldn't you do that? Yeah, kind of like a real estate broker. They make money by finding a buyer and seller and matching them together. They have somebody, their client that wants to sell a house, they find a buyer for it. They get to keep a percentage of the transaction. They don't care whether the price goes up or down, and they don't want to. Their job is to put buyers and sellers together. So no, that's not what the brokers are doing. David Darby, is it possible to ride implied volatility and then sell before earnings? Is there a guaranteed buyer? If there's enough liquidity, generally you're going to find buyers. You can't say guaranteed, but if there's enough liquidity, it's a super, super high probability. Like if you're trading SPY options going into earnings and you're riding Ivy going into that, like say you're long calls and the stock price has risen and Ivy's gone up. Yeah, generally you can find a buyer for that because there's enough liquidity. It depends upon the, if there's enough liquidity or not. What's the platform used for training? We have a Benzinga. If you're asking what's the trading platform, we don't have a specific trading platform. Everybody's from different countries. So we recommend traders use whatever broker works for them. I personally use Thinkorswim, but we also recommend Tastyworks or Interactive Brokers.
Really quick, Chris, just want to give a shout out here to Jazri and T-Raz here for joining the Benzinga Option School. Welcome, welcome.
Welcome aboard.
Welcome to the family,
You're
guys.
gonna love it. You're gonna love it. All right. Peter Ivanov says, I mean, how declining IVFX put options is the price of put contracts goes up or down. So if you are, the price of all contracts is affected by IV. If IV goes up, those contracts get more expensive. If IV goes down, those contracts get less expensive. That's the general rule for how that works. STM Market says, do you show how to day trade options and what factors to look at before you place a trade? Yes, we have a whole lesson just on day trading. And I've even shared a few day trades as well. Yeah, like a Netflix one recently. Okay. Let me just check in with my Zoom real quick. And then I want to get into Peloton. This is better to sell options. I covered that one there. Covered the option chain. The Sir Fox. Is this webinar recorded? Yes, it's on YouTube. Yes, you can watch it later for sure. And Lev is asking a question about the course real quick. It's a 2-week rotation with lessons over the year. Correct. So let me just pull up the syllabus real quick. Let's see here, Benzinga options syllabus. Give me 1 second. Let me pull this up. I will pull up the syllabus. Benzinga option school. Least. There we go. Okay. So real briefly, let me just pull this up, answer a few questions, and then we're going to talk about Peloton. So the way the schedule works is we are on a rotating basis for the classes. We have, as you can see, there's 8 lessons. Lessons 1 through 4 will cover on week 1. Lessons 5 through 8 we cover on week 2. This is Monday through Thursday. This is also Monday through Thursday the next week. And then what happens is we rotate after that 2 weeks. We start the whole rotation over again. So people, as they join, you can join on a rolling basis at any time because you will be able to get back into the rotation. The rotation will always come around. Now, are the lessons static over an entire year? No. As the skill level evolves, we evolve the lessons as well. Like the first time we go around, we don't even come close to, other than the introduction to options, because there's only so much depth you can go into the introduction of options. All of these others have varying levels of depth. And you can't go through the full depth of all these lessons the first time around. It's just not going to happen. Option Greeks, you are not going to be able to go into the full depth the first time around. So as the skill level of all the students increases, we go deeper and deeper into the Greeks. Same thing with volatility. Like we've already done the volatility lesson twice. We're going to do it a third time tomorrow for the first. We're going to do it for, third time tomorrow. And for this first time tomorrow, we're going to introduce new material that we didn't teach in the first 2 weeks. So it's evolving as the skill level of everybody goes up. So yes. But yes, and you get 1 year access to that. Bobby B, should we even bother about VIX if we are not trading SPY options? Absolutely, because VIX will have a massive impact on the overall market and how options are priced. VIX influences SPYs. SPYs influences the whole market. We cover actually VIX in this lesson here in the Benzinga option school on volatility. And then once you understand that, then we get into it even deeper in market gamma lesson. So yes, it's a good question. Simar Deep Singh, for 0 DTE, which means 0 days to expiration option calls, if the IV is still high, Is it safe to hold option calls close to the end of the day? Is it safe? I mean, that depends. There can always be a fluctuation in price that causes between now and the close. Like, let's say you have 30 minutes to close, or even an hour to the close. There's always something that could change the effects of the price and the implied volatility. So you have to gauge that for each individual trade. Lev Karasin says, how do you know what the standard IV should be per contract? If it's too high or too low, what's the baseline? Each stock has its own baseline. There's no fixed percentage. So IV can go from 0% up to the highest IV I've ever seen is like 750%, 751%, which is insane. It's absolutely insane. There's no fixed percentage that works for all stocks because, again, all stocks have different levels of volatility. Tesla can move more up or down in a day than Best Buy or Apple. And so you don't know right off the bat. You learn through watching the options over time. You get experience. Hey, what's the normal implied volatility levels? For example, I can tell you right now in SPYs, if you're looking, say, 2 to 3 weeks out, so like the front month options, expiry, generally in a normal contango environment, generally if volatility is normal, implied volatility is usually around 10%, 12% for like 2-3 weeks out, maybe a month out. But right now it's a little bit elevated because SPYs has been under pressure. You know, like right now, the front month is probably like 15, 18%, or maybe even 20%. That's above average. And so as you get experience with it, you will start to learn what is normal. And so, yeah, that takes time to learn. There's no fixed answer for that. Evelyn says, speaking of VIX, does the Fed come out with a report later this week and will that crash stocks? I have no idea. If you have a psychic ball, I'm happy to listen. Are there any volatility neutral strategies? Yes, there are. Yes. Yes, there are neutral volatility strategies. Yes, we actually go into that in the course. Doesn't the broker take a risk when they lend you the stocks, meaning you sell without owning? So you're talking about trading shares, not options. And brokers are generally hedging those risks. So yes. Can you use margin on options? Yes. Yes. Okay. All right. I think I've covered all the questions in YouTube and in Zoom. Let's get back to our lesson and let's get into Peloton. Okay. So let's pull up a chart on Peloton. Let's talk about what happened here. Okay. Let's pull up the 1 hour chart. And you can see, so this right here is the earnings. This day, it was before market. So the blue is after market and before market hours. The white is the session. So now we're in aftermarket. This is aftermarket in TradingView. My charts are TradingView. I'm not sure if the free version does it, but the paid version will show you aftermarket and pre-market activity. So you don't see the gaps basically. Okay, so you can see volatility or the price action was actually pretty constrained going into it. Traders weren't totally sure what to expect out of Peloton. And then the price action jumped. What happened on this day? Well, there was a news report, I might add, that there is a potential Peloton might be acquired. Why would Peloton might be acquired? Well, if you look at the weekly stock, you can see this stock IPO'd in 2019. It got a huge boon from the COVID crisis, and then it got a little bit of a lift all the way into early 2021. But then it stalled out. I mean, the stock used to be at 160, and now it's at $30. That means the stock is cheap. It has a small market cap. They, probably don't have a lot of funds on hand. There's been a lot of reports how they're suspending manufacturing options. Like, there are reports that they're firing traders. There's a lot of things going on that they are struggling. If your stock goes from 160 down to 30, you are struggling a lot. So a report comes out that there is a potential acquisition or potential buyer. Now, I would like to point out that none of the companies that were suggested, Nike, Amazon, or Apple, have said a word or come out and said, yeah, we're interested. Like nothing. Absolutely radio silence. I don't know about you. It seems a little suspicious, to be honest. It seems a little suspicious. So anyways, I would like to point out one interesting thing, which was that, let's see here. Who was it? Okay. So Ray Clay, I had mentioned I think it was a day before, I had said, you know what? Some traders looking at Peloton, you may want to consider getting long calls. Like literally on this day, and my live members can tell you, they can confirm this is truth. I was literally saying it's either this day or this day. I literally said, you may want to consider getting long calls around 24.25. There is some talk, there is some potential rumors about a potential buyout for Peloton. If that happens, the stock is going to jump. And Reika literally said, hey, your prediction on Peloton, your Peloton prediction was outstanding on 25 on Friday, which would have been what day? The 4th. That was this day. So I literally made it the day before. And then the aftermarket, they announced it. So he traded it, made some money. You know,
Yeah,
anyways,
just want to
I'm
add
tooting
there.
my own horn.
Just want to add there, Chris.
Yes.
I actually, I know that you put trade ideas in the chat room. So that is where I initially started looking at Peloton. I went long on shares around $30. And but in that case, even for people that don't trade options, like this is still a great tool or resource.
Huge. So thank you for sharing that. I appreciate it, Rodrigo. And I think you got to take me out to dinner since you made some money on that. So
yeah, you'll be here. Okay.
All right. So before the day before earnings, which is this white session here, let's zoom in a little bit. There's the announcement, potential acquisition. It shoots up definitely. And you can see that volatility or volume was very low. And then the day after the announcement, volatility increases massively. So now there's increased activity in Peloton. And then earnings comes out right before the market opens. And the earnings were actually a miss. They totally missed. They missed on earnings. They missed on revenue. And some of their forward guidance actually wasn't that good at all. There was a piece of interesting news in there that might be part of the reason why the stock rallied on the day. The CEO, I think his name is Jim Foley or John Foley, has been kind of under pressure. If your stock's gone from 160 down to 30, your position as a CEO is probably under threat. And so they just announced in the earnings, hey, he's stepping down and they're bringing somebody else in. Maybe some of that speculation led to, hey, Peloton's really working on being acquired. It doesn't really matter. The bottom line is traders kind of looked at it. They had already built up a lot of positions and traders kind of looked at it and said, you know what? This sucker's getting acquired. And so what happens with share volume? It explodes. The share volume on the day was absolutely insane. Total share volume had hit 245 million shares. It also brought the 10-day average. Prior to this, the 10-day average, I think was like 25 or 30 million shares on a day. So this literally traded about 10 times its normal share volume average. And clearly traders were buying shares on this. Keep in mind, this sucker has missed the 3 out of the last 4 earnings. And yet traders are buying on the potential idea that the stock is going to get acquired. And if they're right, and if it's acquired for a price above 30 or 35, they might make some money on it. So traders rushed in to make a lot of bets on the day. Okay. It's partially what happened with why the stock went up. Now, with that being said, if I look at Peloton prior to today, what was the total number of options Peloton had prior to this trading session today? Prior to today, at about 500,000 calls, at about 480,000 puts. So roughly relatively even between calls and puts. Of all the options that were out there, about 45% of them had expired last Friday, and there's a lot of options expiring this Friday. So the stock had roughly 1 million options going into the session today. But on the day, the stock traded 1.1 million options. 1.1 million options. It literally doubled the option volume on the day. The total open interest, all the options in the universe prior to today was about 1 million. And in one day, it did more than that. Absolutely huge. That's part of the reason why the stock skyrocketed so much. It's also part of the reason why you have like 245 million shares traded on the day. Okay. So in terms of why Peloton, it doesn't really matter the why. Like the whys really don't matter. The real why is traders gorged on shares and they gorged on options. That's the why. Order flow is the ultimate why. Doesn't matter whether it was technical or fundamental or sentiment or flow based. In all of those reasons combined, the one ultimate why is traders gorged on options and they gorged on shares, and it sent the stock skyrocketing. Okay. So now if you think about this, Peloton already had implied volatility that was building up leading into this. It gets a bigger boost from this announcement. And then today, implied volatility skyrocketed, absolutely skyrocketed. We even wrote about this in the Benzinga Option School. So I have my own chat section where we talk about trade ideas. And I wrote at 9:21 a.m. Pacific, and we're going to get into like how close I was to calling the intraday top on the day. So what did I write to the members in real time? Peloton has exploded in share size today. At the time, it was all over 150 million shares. So at 9 a.m. Pacific, we still had about 3.5 more hours of trading. It did another 100 million shares. And Ivy has spiked to over 250%. 250% for the February 11th options. The at the money February 11th options. And I said, I don't think this is sustainable, especially since there are boatloads of short dated options. Over 200,000 of at that time, there was only 720,000 options traded a day. So literally 1 out of every 3 options was short dated. That means it was expiring this Friday. So a boatload of options comes in and a huge amount of them are expiring in 3 days. That's problematic. That means theta will start to kick in heavily on Wednesday, Thursday, and Friday. In other words, everybody who bought long calls and rushed to buy long calls on Peloton today that are expiring this Friday, come Wednesday, come Thursday, come Friday, they're going to start to see theta decay, time decay come in their options. Huge, absolutely huge. Okay. I further stated, I suspect unless they find a buyer this week for the acquisition, the stock will pull back due to massive time and IV decay, implied volatility coming down after the earnings, and the theta decay kicking in on those short-term options. There are huge amounts of short-dated calls at the 40 strike, but very little beyond that. This means Peloton might struggle to get beyond $40 today. And if nobody's buying calls beyond $40 expiry, or for the next expiry. So if nobody's buying $41, $42, $45 calls in large numbers for the next expiry or after that, then we have our short-term resistance for the week. So I'm looking to short here soon once I see enough weakness. We'll do so with fixed risk options, as there's always a chance it explodes higher, but it's unlikely we get another day like this with 150 million share volume on the day. One last thing. The 1-minute charts show a volume spike on the move into the highs at that time around 39.16. This latest push up into the highs shows a weaker volume spike, suggesting the upward move may be weakening soon. Look for transitions and structural breaks on the 1-minute chart for exhaustion on the day. Okay? This post at 9:21 Pacific. Now, let's look at Peloton on the 1-minute chart. Okay. So I wrote this at 9:21 right there. Okay. And so we can see this kind of candle right here. Let's zoom into this a little bit. And so what was I seeing on the 1-minute chart? Huge explosion, move from 35 up to 39. We get a corrective pullback. You can see, though, into the move in 39, the biggest volume spike on the day. It tries to push back into 39 and a lower volume spike when I wrote that. We get one more push. And what did I say? 40 is probably close to your top on the day. Even though the volume is spiking, it's still not as high as this one. That means that we're not able to push more volume. And if you can't keep pushing more volume, then it's going to struggle to get higher. And what was the high on the day? 40.31. The stock never got back to 40.31. And then what did it do within 20 minutes after I wrote it? It sold off from 40 all the way down to a low of what, 36? 36. I literally called the intraday top within 20 minutes. How did I do it? Because I understood options, because I understood price action, because I understood volume, and I understood implied volatility. When implied volatility keeps going higher and higher and higher, eventually it's going to get to a point where it makes the option so expensive, you're not going to find many buyers. If you think about a house in terms of pricing, it's kind of like a pyramid. If the house is cheap, you're going to find a lot of buyers that can afford that house. But as it goes up in price, as it gets more and more expensive, you're going to find less and less buyers. Options works the same. And if implied volatility keeps going up, pretty soon you start running out of buyers. Now, I'd like you to think about what it would be like if you were trading Peloton. Here it is. Here's Peloton. Peloton is screaming. Here you are. This is the right edge of your chart. You don't know what's happening past this. And you see, wow, it's going to 40. It's going to 40. And you're thinking, oh, I'm going to get long calls. This is going to 45. I'm going to buy calls going to 45. And then you see that note from me. Would that have saved you money in avoiding buying long calls at 40 or 39 or 38 and eating theta decay? Yeah. Yeah, it would. My job as a trader is to first help you to make less bad trades. And this is one of those ways that I do it, but then also to give you ways to make good trades. So I help you make less bad trades. I mean, imagine what it'd be like if all the losses you had, I'm sure not all of them were bad trades. Some of them were probably good trades. They just didn't work out. It's going to happen. You're going to make good trades. It's not going to work out. Quarterbacks, Tom Brady can make a pass. It could be a good pass. Doesn't catch it. It's going to happen. So you're going to make a lot of losses in your lifetime. It's going to happen. But imagine if you made 10% or 20% less losses. Could that be the difference between you making money or losing money on a year? Could that be the difference between you making a little bit of money or a lot of money on the year? Yeah, probably would. And imagine what it'd be like to have that kind of real-time analysis when a stock is going nuts, to have a 20-year professional sit there and say, watch out, this is probably going to run out of steam at 40. Oh, and look what happens. If you had bought calls here or here or here, and you were saying, hey, I'm going to hold it to the end of the day, you would have lost money. And had you been in the Benzinga option school, you would have not lost that money, which means money in your pocket. So yeah, it's up a little bit in after hours. Not gangster. We may have one more day of rips in Peloton, but are we going to have another 245 million share volume on the day? Not going to happen. Not going to happen. It's not going to do 245 million shares on the day. It probably hasn't done that in months, if any. Like, you look at the volume and there's nowhere on this chart where it even comes close. There's a couple bars here that do, but is there anywhere on this chart? I mean, let's look at some of the top volume here on the day. And this is just a massive amount of volume. Let's draw a horizontal line right here. It's like the top volume bar on the chart. And the majority of volume for the first several sessions or hours is right here. So those are your volume levels. Now, if we scroll back, where do you ever see anything like that? Nothing. It's a rare day. It's probably, if it's got another decent day, it's maybe got one more day at best, and then it's going to start pulling back. Why? Because all those people who bought long calls that are expiring this Friday, every day they hold that overnight, they're going to lose money on that option. It's called time decay or theta. And right now, the theta, everybody who held those calls overnight, the theta on the 38 calls is 44 cents. The 38 calls are only worth 281. So they lost 45 cents just by holding it overnight. If Peloton goes nowhere by tomorrow morning, that option is no longer worth 281. It's worth 235 because it had accrued theta decay. And if they hold it again and the stock goes nowhere, it gets even worse and worse and worse. So at best, Peloton, if nobody announces, hey, we're acquiring it, if Nike or Amazon or Apple comes in and says buying it, the stock's going to go nuts. But if it doesn't happen, and I'm assuming it's not going to happen, then they're going to maybe at best have one more day of ramps, and then it's going to start to sell off to end the week. This is how this works. Implied volatility eventually gets too high, becomes too expensive. You get less and less people that can afford it. And that means there's less people to prop the stock price up. And so it eventually comes back down. This happens over and over again. Okay. Plus, you're also going to get an implied volatility crush, as Robert points out. That's not the only reason. The share volume was massive. It elevated the stock. But as we go on more and more, implied volatility is going to come down more and more and more and more. And that's going to hurt those options. And that's going to force the people who are long calls to say, implied volatility is getting too low. Get me out. If the stock goes absolutely nowhere, time decay is going to trend to zero. As all options trend to zero in terms of time and volatility, eventually the volatility will come down. It will affect the options, and the time decay will eat the options. So they will just continue to lose money. Okay. Any questions on this kind of Peloton idea we've been talking about?
I got a question here. Someone emailed me a question actually. How would you consider into your formula, like, some sort of like short squeeze or something like that, if that's the case with Peloton?
So we have to understand there's a difference between a short squeeze, in terms of short interest. I think it was like 12%. But there's a difference though. Short squeezes require traders to get long shares. If you really want to short squeeze a stock, you do it via options. Because that's how you can create a gamma squeeze, which actually tends to be bigger than a short squeeze. A gamma squeeze can fuel a short squeeze. Am I taking the short squeeze calculus into consideration? Yeah. But I also know that when you have 1.1 million options traded and about 300,000 or 400,000, those are expiring this Friday, you're taking a lot of the option fuel out of the market. So even if there is a short squeeze, the option players are exiting out of the market because a huge portion of them are expiring this Friday. So you're taking fuel away from the market. And so I'm happy to trade that. Is it a possible short squeeze? Possibly. That's a possibility. That could help. But 12% of the total float, it's not huge. And again, if option traders start exiting the market in droves, that's going to drag on the stock. So yeah, even if you don't trade it to the long or short side, imagine if you were that guy or girl and you're thinking, it's like right here at 40 and you're thinking, wow, this thing's screaming, it's going to go to 45 and you're about to buy calls here. Imagine if you had the skills to be able to read the option chain and be like, I don't think it's getting past 40 today. Not much call open interest beyond that. IV is too high. IV eventually has to come down. There's a lot of things that would influence your decisions. Just the skill of learning to be able to trade options and read an option chain and understanding implied volatility and understanding options, that would help you make better decisions alone on your stock trades, just on your stock trades alone. So super, super important. All right, let's take a look at some questions here. Kristen says, side note, looks like we both just got the alert on Facebook crossing a trend line. I don't pay attention to individual trend lines, but thank you for sharing that. I appreciate it. Rodrigo sharing Citron Research posted a bullish report. Also, Barrett upgraded JPM. Yeah, you're going to get some upgrades for sure. Do you think Peloton is going to be the next meme stock? Possibly. If they don't get acquired, then I think they have the potential to become a meme stock. You know, I've heard from employees directly that they are laying off workers left and right. Like some of them are getting excluded out of Slack groups and things like that. Some of them are saying, hey, management's coming in and they're not even allowing us to log in for the day. Like they're cutting employees. If you really think your stock, your company's in a good position, you don't start just laying off bunches of employees. Laying off employees can actually help because you're cutting your costs. That can definitely help a stock for sure. But generally, a company is not in a position if they're like locking employees out, the CEO's resigning for somebody new. You know, I mean, there's just a lot of things about it. So possibly, it certainly could become the next meme stock. You shorted the 50 calls that expire this Friday. You sold the 50 calls. It's ballsy. Are you long shares, Gene? Because if not, you have open-ended risk. If you short calls naked, you have open-ended risk.
Oh, and I got another question here that was sent to me by email. Looks like somebody, it was their first time trading options. And it looks like they just went to like some general forum, like Reddit kind of board. Looks like they decided to short Peloton and they're not sure how to handle the trade now. Looks like they bought some puts and they're down a lot on those puts for Peloton.
If they can post the details of the trade idea in the chat, I can take a look. So I need the strike, how much they paid for it, what's the expiry, then I can take a look into that. That's the kind of analysis I actually do for my members. So for the members in the Benzinga Option School, they have these student trade ideas with Chris for student trade ideas. They post all their trade ideas and we analyze them every single day. We analyze like, hey, here's the new trades today. Let's go through this. So we went over Roku today. Somebody had a trade on Peloton. We had another trade on Peloton. We didn't get into this one today. We didn't get into anything beyond that. We went over BTU today, Peabody Energy. Like we go over these trade ideas every single day. So imagine if you had a trade idea and before you took it, you got to have a 20-year former hedge fund trader, Wall Street pro, analyze that trade before you took it. How valuable would that be?
It's the community, like you can't compare being out there in the wild with fake bots, fake accounts, and being here with real students and yourself. So that's the difference. I would say to whoever emailed me that.
Yeah. Gene's saying he sold the 50 calls expiring this Friday. He's already long 40 and long 40 calls 35 days out. Okay. All right. So you got like a calendar basically. Okay. All right. Ballsy. Bobby G, will we be able to sell when we run out of buyers when we close a profitable trade? I'm assuming with 1.1 million options, you're probably not going to have a hard time closing out your trade. It's possible it can happen, but we're talking about a highly liquid stock and highly liquid options. Like generally, once you have above 1 million options, you would have a hard time not getting filled. You may not get the best price, but you would have a hard time not getting filled. Would you then sell 30 calls tomorrow? I would not sell naked calls on a stock that has been exploding in share volume. The risk are just not worth it. If I was long shares, would I sell a 30? I wouldn't want to sell a 30 call because that's below the market. Those could be instantly exercised. So I wouldn't sell a 30 call tomorrow. No way. And I would never sell naked calls. Only under extreme conditions would I ever sell naked calls. Because if you sell a naked call, you technically have unlimited risk. If you sell a call, then you are short the market at that strike. So if you sell the 40 calls, you're short at that strike. Basically, you want the stock to be at or below 40 by the time of expiry. Well, technically a stock can go to infinity. I've never seen it happen, but it can. So if it explodes up to 300 or 500, I have asymmetrical risks. Never do that. I would never do that. Tree Buon, yet I was saying, is it good to buy put options on Peloton and considering the next week expiration date? Okay, it's a great question. So what is one of the variables that affects the pricing of options, calls or puts? Implied volatility. Now, if implied volatility is high right now, doesn't it mean that those long puts are expensive? They're overpriced. Yes. So if you're going to buy puts, yeah, you can make money if the stock goes down. But if implied volatility comes down, you're going to lose money on that IV coming down. So you might make money on direction, but then you're going to lose money on implied volatility coming down. I generally wouldn't recommend it. I think there are more sophisticated options to deal with that. Should Bobby G has a question. Should we exit option trades based on option price or stock price? Both. Never one or the other. And again, option price, it doesn't, even though it incorporates the Greeks give you a different idea of, hey, is this option going to be worth it for me to hold at night or not? There's a lot of variables on whether you should exit. I wouldn't just look at those two. Some more, we got a few more questions, and then I want to get to my YouTubers. Is it true that as VIX drops below 20, market starts to stabilize and becomes more bullish than bearish? Yes, because implied volatility is down. That means you have very little fear in the markets. You have very little people that want to be long puts. So they tend to be long calls or selling calls further up. So yeah, generally markets are in what we call positive gamma mode. We talk about that in the live Benzinga, in the Benzinga option school. Andy's saying, so is order flow the overwhelming factor? Always. Order flow is the most proximate driver of price action. Share flow and options order flow. Keep in mind, those 245 million shares that were traded today, they're all traded for various reasons: technical, fundamental, sentiment, flow-based, and maybe any combination of those. And the options are traded for maybe sentiment, technical, fundamental, flow-based, maybe Greek pricing, maybe volatility. There could be a lot of things. Maybe any combination of those. You'll never know the one why, and there rarely ever is one why. There's multiple whys. But what do all those whys become? They all become order flow. And the most dominant order flow, whether it's to the buy side or the sell side, is what's going to drive the price. If you see 245 million shares traded on the day and 180 million of those shares are traders buying the stock, it's going to go up on the day. If there's that many shares and most of them are selling the stock, it's going to go down on the day. So order flow is the most proximate driver of price action. Yes. Amy Million says, how do you know the number of options expiring this Friday? So you can get some of that data in the Thinkorswim platform. It will tell you the volume of the options for the February 11th strike. And so you know, based on that volume, how much is potentially expiring this Friday. I also have a proprietary app that collates the data once a day. Where does the data come from? OPRA, the Options Pricing Something Authority, whatever it is. I don't know what the initials stand for. It doesn't really matter. OPRA.com, they are the options pricing authority on that. They disseminate all the options data. I have a subscription with them. I have an app that collates the data. And so, yeah. But yeah, I have a proprietary app that analyzes the data and estimates the amount of options. Do I think Nancy Pelosi is the best NVIDIA trader east of the Picos? I think if Nancy Pelosi is no longer in office, I think she might have a hard time beating her returns. It's just me. Some people have call-outs about other stocks. I got a few more things I want to talk about. If we have time when this is all over, we can go over that. But we only have 20 minutes left. And I still have more about my presentation. Okay, let me get into some of my YouTube questions here. My YouTube peeps. Mike Askin, Chris, would it be a good idea to buy puts for this Friday to make money on options? So I answered that question. Puts are going to be expensive right now. Remember, when you get long puts, you're long volatility, you're long implied volatility. That means you want implied volatility to go up. If implied volatility comes down, you're going to actually lose money on those options. So I generally don't recommend getting long volatility on single legs, especially when IV is high. Peter Ivanov says, Chris, do you check all that info on the number of calls and puts, their expiration, their IV analysis, rare option chain? Do you have a special platform? I have a special app that collates all the data from various sources. And then and then it allows me to analyze it and kind of make a decision on that. Some of that is free. It comes from Thinkorswim, but some of it's from a proprietary app I have. Why would Nike or Amazon announce a buy, as that would drive the price higher? Possibly. The fact that they haven't said anything is a little questionable. Like nothing, not a word out of it. So yeah, usually you get them responding in one way or another. Nothing. No executives, no leaks, no nothing. So would it be a short pot first thing in the morning and then short it? It depends on how many people get long shares. It could do 100 million shares tomorrow. It could easily do 100 million shares. Is that enough to push it to 45.50? Maybe not. Maybe not. There may also be people part of that volume, maybe people who are long shares right now and is selling. There could be a lot of reasons. So it's hard to say. I'll wait till tomorrow and analyze it. Gary R. Best thing about the course is being trained to understand how to figure this out yourself. The knowledge I've gained with Chris has saved me the cost of the course. Less losing trades, more winners. That's awesome, Gary. I appreciate you sharing that. And I'm glad to hear on that. Ian Brodsky says they could get bought out for more than 50. Yeah, it's certainly true. Yeah, certainly true. That's why I recommend fixed risk strategies if you are going to short it. Sport Biker. Chris is a great instructor that loves to teach us stuff. I do. I have to admit, I get a kick out of it. There's been so many eye openers for the folks that are in this class. I appreciate it. I really do enjoy the teaching. I love trading. I love teaching. I love them both. I feel very lucky that I get to do both things of what I love. Let's see here. Somebody's asking about Disney and Affirm. We'll be able to get to that soon. Okay. I think I've covered all the YouTube. Robert, Tampa Bay Buccaneers. How about explaining to new folks that spreads, which reduce your risk? We don't have time for that. We only have about 20 minutes left. Yeah, that's a lot for us to, as I said before, I don't recommend trading single legs when implied volatility is high, because if you're going to get long calls or long puts, you are long volatility. And you basically need implied volatility to keep going higher for you can make money on direction, but if implied volatility collapses, you're going to lose money on the volatility collapsing. So really what you want is when you're long calls or long puts, you want, in terms of the volatility spectrum, if this is low volatility and this is high volatility, that's an awful H. You either want to buy when volatility is low and have it go up, or if you buy when it's high, you need it to go higher. You need it to go higher. If you're buying when it's high, you always have to be careful. That's why I do not recommend buying single leg calls or puts, because you're overpaying for them. And if implied volatility comes down, you're going to lose money on them. So that's why I recommend alternatives like spreads or broken wing butterflies. Those are strategies we cover in the course and how we trade them. Thank you for your suggestion on Peloton put option. Makes great sense. You're welcome. Good stuff. I have a small 4K account. Do you give us alerts to do a learning class and allow us to make option trades? Yep. I do give trade alerts. I gave a trade alert, I want to say last week on Netflix, which totally crushed it. I give a few alerts a week. I'm not going to be giving alerts like 20 a day or something like that. But I gave an alert on Netflix at 11:04 on last Wednesday. And if you look at Netflix and what happened, so Netflix last Wednesday was the 2nd. So on this day, what did I do? Very early on the session, shorted Netflix. We did a broken wing butterfly, 430, 415, 412 and a half. And the stock just sold off. Totally crushed on that one. So I do give alerts probably a few times a week, but I also analyze the students' trades. They post their trades. I analyze it. And then Fridays, we're implementing a new thing. Fridays during our office hour session, we go through one demo trade a week. So yeah, we go through one demo trade a week and we go through the different strategies so that the students can have experience with the different strategies, understanding the Greeks, how does profit and loss change as it goes on and so forth. So yeah. Volume is your day. How does option block trades affect your decision to buy or call or put? Not really, unless it's in a really enormous block trade. Keep in mind, Peloton did 1.1 million options today. So if you get a block trade for 5 or 10,000 options, that's a drop in the bucket. So yeah, I'm grounded for 90 days from day trading. Did your broker ground you? Oh, does your class have option strategies that don't require day trading? Yeah, we do swing trading. We do long-term trading. Absolutely. How much of your daily discussions require day trades? Mixed. Probably maybe half day trades, half not. You don't have to day trade to take our course. We have plenty of ideas that are swing trades as well. And we have plenty of ways to trade the same strategies without day trading. So yeah, one fun fact, if you've gone over the PDT rule or broken it for whatever reason, and you can't make any more day trades, there is a way around it with options. You can do a 0 days to expiration trade and let it expire. If it expires, it actually settles the next day. So even though it's 0 days to expiration, it technically doesn't settle to the next day, therefore is not considered a day trade. We got a tip and wants an analysis. Oh my gosh. I didn't even know we could do that. Tips and an analysis. Wow. Okay. All right. Let me answer these questions. Furcon Emporium, and I will answer that. That's a beer. That's a beer for me. So, do you teach how to trade weekly options, expiring weekly options, especially options and futures like ES and MES? So I don't trade futures, but we do teach SPYs and Qs as well. Yes. Do you always trade the same distance from expiration? No. What is the furthest out you go? I've gone over a year out. Yeah. But I would probably say 60% of my trades are usually within a month, like a month expiry. And then the others are, various expiries beyond that. I'm not sure I'm going to have time to talk about option screeners. To be honest, I generally don't use most option screeners. I tend to actually use Benzinga Pro and their movers because I want to know what's moving. That's more important to me. The bigger the share volume, the more it's moving. That's, more important to me. Peloton was the biggest mover on the day. That was the one I isolated the most. So I tend not to spend time on option screeners because if I'm spending time on option screeners, I'm missing what's moving. What's moving has the highest liquidity with it. So I'm more concerned with movers than I am with screeners. It's far better to find options and trade ideas on movers than screeners itself. Okay. I think I've covered all the questions in Zoom. So let's take a look at, he has a question on apps earnings release tonight. Didn't they already release it? Let's take a look. Digital Turbine. Okay. Whoa, that's big up and down. Okay. Beat on earnings, beat on revenue. Let's see what Benzinga Pro says about it. And Rodrigo, make sure that $2 comes to me. I want that beer. I want that beer.
No worries. You got it, man.
That means you owe me 2 beers now. All right. Digital Turbine, 49 EPS beat, 43 estimate. Sales beat. It's a decent beat. Okay. What's their forward guidance? Did they give forward guidance? They did not give forward guidance as far as I can tell. Okay. Okay. Forward guidance would have really helped. That probably will come out maybe tomorrow. Okay. So let's take a look at apps real quick. Let me see the flows on the day. Let me see the flows going into it. Hey now. Hey now. Supposed to behave. Apps. There's some dark pool interest in apps. It's kind of interesting. Prior to today's trading, apps had about 90,000 calls, 61,000 puts. So it's what I consider in the lower volume in terms of open interest for the stock. Like generally I want 100,000 options before I even touch it. This is about 150. That's not bad. How many options did it do in the day? Wow, that's strong. That's strong. So it had about 150,000 options. Today it did 51,000 options. That's 1/3 of the total open interest in one day. That's strong. how much of that is short dated? 31,000 calls, 20,000 puts. So more call based, which means that if there's a lot of short dated options, they're going to be under pressure to close those options on Wednesday, Thursday, and Friday. So it said 50,000. How many calls were there that are short dated? Maybe 10K, and then maybe 8K. So about a third of the options on apps are short dated. So there's gonna be a decent amount coming out this Friday. I have to see the updated data on the overnight data. Oprah releases at midnight Eastern. So I need to kind of wait till the updated data comes in. Let's take a look.
What's going on there with GameStop?
We will take a look at GameStop shortly. By the way, I had said at the beginning of the year, like in the first week of January, I said I'm bearish on GameStop for the year. I think it's going down to 50. And I said I think AMC is going down to 12. AMC went down to like 13.30. I still think AMC is going down. So in some sense, I'm happy that GameStop rips, because the higher it goes, the better I can sell it. Okay, so let's take a look at apps real quick. Where are we at? We're at 45 right now. I actually like, I need to see more on the earnings, but I actually like buying apps around $40. From an options perspective, I think it's solid support there. Once we start getting below 40, the hedging impacts from dealers starts to actually, particularly the gamma hedging impacts for dealers, starts to become actually favorable, meaning that as the stock goes down, they are not selling shares. They actually start buying back shares, or they're selling less shares. So they're removing some of their short share hedges. So my proprietary app analyzes hedging impacts from dealers and things like that. And as we start to get into 40, the hedging impacts from dealers is not pressuring it further lower. It actually starts to become supportive around 40. So yeah, I actually like buying apps if we get a dip on the 40. I'm going to put an alert for myself there around 41. If we get down there, I'll take a look at it. But assuming there's nothing bad out of the earnings or anything like that, and it does happen to dip after earnings into like 41 or 40, I like it. I like it. Yeah. Ugly Ivy Crush on apps. I didn't check. Let me check the IV on that. 290%. That's pretty heavy. That's pretty heavy. Let's take a look at what historical weekly is. Weekly. So right now, the implied volatility on the weekly chart is about 1.15 and the historical is 74. That means there's a huge dislocation between implied and historical. So the implied is probably going to come down massively. Probably over the next week or two, you should see implied probably come down massively. Unless there's no new event, you should see it come down massively and start to normalize closer to historical. Generally, implied is above historical, but that's a pretty big spread from 115 down to 74 on the weekly. So I would expect that comes down. To me, Ivy seems a little rich. It seems a little rich. Yeah. Yeah, it's a great question. Okay, Furcon Emporium. Hopefully I have given you some decent analysis on that for your $2. Had about 280. I know it's super high IV. Yeah, I do believe they are undervalued. And I think they are, I think if they happen to go dips into the low 40s, I think it's a good opportunity in my opinion. Yeah, I'm with you. I'm with you. Okay, I got about 7 more minutes. Shoot. How many more slides do I got? One. Okay, I only got one more slide. Okay, let me answer these. Let me go through these slides and just this last slide. And then let's kind of end with some questions and then we'll call it a session. 2 hours. I've already done 3 hours of classes on the day. So this is long for me. I got a glass of wine waiting for me as soon as this is over. So I'm very anxious. Some earning trades mistakes, buying calls like right before the earnings, buying calls or puts right before. Why is it a mistake? Because IV is often high and the IV often collapses. So if the stock goes nowhere, you could buy a call and the stock could go up you're going to gain on the stock going up, but you're going to lose money on the IV going down. So you actually, you either make less money or you can lose money on the option itself. So I do not recommend buying calls and puts like the day of, the session of, a few hours before earnings. This is generally a big mistake that newer traders make. Getting long volatility, this is kind of along the same vein. Getting long volatility like the day of, right before options releases, again, that's a big mistake because you're getting long IV, and if IV collapses, you're going to lose money as IV comes down. That's a big earnings mistake that a lot of beginners do. Also, trading open-ended risk. So if you were to just be like, hey, I want to sell calls, so that would be minus C, at whatever price, because I don't think it's going to spike up there. That is an open-ended risk trade if you don't own the shares. So the stock could go to infinity. It could go to, CAR, which was Avis. When they heard about Hertz, Hertz comes out and says, hey, we're going to buy a fleet of 100,000 Teslas. And the stock just skyrocketed. And so CAR executives were smart and they picked up on that. And they're like, we're going to buy some electric vehicles too. And what happens when CAR explodes 300% in one day? Did it come down all of that explosion? Yes, it did. But the bottom line is it did that. And so if you were short calls on call or CAR before that happened, you would have gotten nuked, like completely nuked. You might even owe the broker money at that point. So it could be tens of thousands or $100,000s of dollars. Like that can happen when you have open-ended risk. Do not trade open-ended risk trades before earnings. Do not. And if you are, close them before earnings. The risks are asymmetrical. They completely outweigh the gains you get from selling those calls. Do not trade open-ended risk. And after, don't do it after, because the stock can't keep exploding higher or lower. Maybe you sell puts. Maybe, the earnings are good. You're like, hey, I'm going to sell some puts. And you are not short the stock. Well, the stock can technically go to zero. And if it does, you're going to lose a lot of money. Do not trade, open-ended risk trades like short calls or short puts after earnings, because the stock can go to infinity or it can go to zero, and that could wipe out your account and then some. So these are some of the major earning trades mistakes that a lot of traders do. Those are the basics. If you want to start looking at more of them, we've talked about that in terms of not understanding implied volatility and so forth. Let's see. Isaac, Isaac, where did you check the IV? On my platform, my broker platform, Thinkorswim has it. It's free to everybody. Do I go over dark pools and education around that or in conversation? Yeah, we go over it in conversation. It's not a major conversation, but we go over that. Yeah. And you can get FINRA. I think there was a law that made that FINRA has to publish the dark pool data. You can just go to FINRA, search dark pool. You can find the link. Yeah. Yeah. What is IV shoe and put call parity? I think what you mean is IV skew, so implied volatility skew and put call parity. That's beyond the subject of today's lesson. I would need probably, a good 10, 15 minutes to go into that, explain in detail. So it's beyond the focus of this. So yeah. Okay. All right. Sadly, I didn't have time to cover Disney or AFRM, but I did kind of give you some of the playbook of what to expect, what to watch out for, and potential trades you want to avoid, and things that you can consider after that. If you'd like to learn more how I might be trading this or trade ideas I might have when the earnings comes out, we will talk about those trade ideas with the Benzinga Option School members. But yeah, this has been 2 hours. I feel like I've covered a lot of material for free in the last 2 hours. And I feel like whatever I just gave you for free, that's just like a small snippet or small, like kind of soda straw look into the Benzinga option course. We talk about options for 3 hours a day, Monday through Thursday, and then an hour on Fridays. We go over live trade ideas. We go over your trade ideas, other student trade ideas. We analyze them in detail. good trade, bad trade, what to watch out for. I would do this. Hey, I like it at this level. Hey, that's a good trade. I'll take that one. We give, several trade ideas, generally on average a week. We talk about everything that you can possibly imagine from beginner to advanced, as it shows in here in the Benzinga Option School. We always have an introduction option class once every 2 weeks. We have a whole class on just the Greeks. And that is something that generally takes, if you're not experienced in options, it usually takes at least 3 or 4 times before you even feel like, okay, I really understand this. It's such a rich subject and it's complex, but it's the kind of complexity that once you understand it, it actually becomes a friend. It means you can start leveraging multiple trade ideas. Some traders, option traders, just trade volatility. That's all they trade. That's all they trade is volatility, increases or decreases in volatility. Some option traders are just hunting for theta decay. That's it. They're just hunting for theta decay. Some option traders are just looking for gamma squeezes. Some option traders are looking to trade differences in the skew and the surfaces. So there's a lot of things that inside the Greeks that traders can isolate, and those create opportunities. And when you learn that, the market starts to make more sense, not just how things move, but why things move. Why are the option flows moving the market this way? This is an important thing. I've noticed a lot of the traders start to see the market differently once they understand options. They're like, wow, this makes sense why the stocks are going up or down, because they understand what's going on in the options. And right now, options trading is on average larger than share volume average. Like the most recent statistics that I saw at Goldman Sachs was, this was back in end of January for the January expiry. There's 3.3 trillion in notional options, 1.3 trillion in single stock options. That is huge amounts of volume. 1 trillion in the SPX, the S&P 500. Huge, absolutely huge. Options volumes are exploding. That means they're pushing around the market. And if you don't understand how they're pushing around the market and you're just trading stocks, you might be getting in some trades that you don't understand what's happening over here and how the options market is pushing your trade around. So if you're not learning options, you are missing that 800-pound gorilla in the room. Right now, options is the 800-pound gorilla in the room. It's causing some of the biggest flows in the market. If you don't understand what's making the waves that you're surfing on, how can you surf really well? So super, super important that we all understand that. And that's what we talk about day in, day out. Okay. I am going to call it a sesh. It's been 2 hours. I have now spoken for 5 hours on options on the day. I have a glass of wine that is really, really waiting for me. And so I'd like to call it a sesh, but some great questions. There is one question here, Bobby G. Is not there a lot of course repetition for early birds in the course over a year? Yeah, that's true, Bobby, but we also evolve the lessons as they go on. We go deeper and deeper and deeper as they go on. There's no way to cover everything you can in option Greeks in 1 2-hour class. It's just no way. It's impossible. Like option Greeks, you could spend a year learning option Greeks and still go deeper. So we go deeper all the time. Volatility. Again, we're going deeper. We're adding new material, and this is the 3rd time around. The single legs, you can only go so deep in that, but 2s and 3s and 4-legged options, yeah. Market gamma, which we didn't even talk about today, which has to do with the overall market option positioning and how the gamma notional affects the volatility in the markets. Dealer hedging activities. We go over option dealer hedging activities. That's a massive subject that could take months to explain. So it all evolves. And then on Fridays, we have new material because every Friday we place a new trade, a demo trade, and we analyze that in real time so we can show how people can get experience with all the strategies. And then we're kind of leaning towards doing like a color lesson of the month, which is like once a month, we'll poll the students on, hey, what would you like to learn about inside the option space outside of the course lessons? And then we'll teach that once a month. So the lessons are evolving, they're changing, they're adapting as the skill level goes up. We're giving new lessons, once a month. On top of that, we're covering live trades. We're evolving the lessons that are there themselves. This is Joe saying, hey, this is my third time watching Chris, and I'll say I'm happy to be in the class tomorrow. Yeah. Okay, a couple more questions. We also deal with the live market, which changes. Yes, the live market's always evolving. Super important. Brad Barnes is very knowledgeable. Thank you. I appreciate that, Brad. Chris Gaskin says, what's the average portfolio size of the current people in the class? I don't think you have to worry about that. It's all over the place. From 1,000, to many 6 and maybe some 7-figure traders for sure. But you don't have to worry about that. Everybody in there nobody's comparing based upon portfolio size. There's plenty of small traders in there. You don't have to worry about that, Chris. Is this a good course for a new option trader? Yeah, we do have, we start from the ground up, introduction options, and work our way through. We cover like years of material, things that have taken me years to learn in 8 lessons. And so in terms of a new person, absolutely. If I could have taken this 22 years ago when I started learning trading, I honestly think I would be a centimillionaire today. If I had this information 22 years ago. I would have gladly paid this amount of money to get this back then. When I first started trading, there was only like 6 websites on the planet that taught about options and FX and things like that. 6. Now there's millions. So yeah. Sharon Love says, thank you. I'm brand new to trading. It's all good. We have a lot of people that are new to trading in our course. Aurelia Rodrigo has that information for you. Buzubad says, nice one. Thank you. You're welcome. Good stuff. Sharon said, is this a good course if you've never traded before? Absolutely. We have a lot of beginners in there. Is this a new course from Benzinga School? Yes. It started live in the middle of January, I think January 10th. Yeah. So it's less than a month old. You're welcome, Chris. I'm glad you enjoyed the time. And to you, Tribuan Yadav, I'm glad you like it. Okay. All right, sweet. All right, guys and girls and men and women. I'm going to take my boyfriend's a successful trader, but he won't teach me. That's fine. I'll be happy to teach you. Who knows? I might even turn you into a better trader than him. Wouldn't that be awesome? Like if you were to take this course secretly on the side and not tell him, and then like all of a sudden you start asking him questions like, hey, so can you tell me about the volatility surface on this option? Can you tell me about, the theta impacts on this one here? Or, hey, can you tell me about market gamma on this? It would totally blow his mind. So Sharon, I almost encourage you to take it just because of the fact that if you take it in secret and then like all of a sudden you come out like a couple months later, start explaining these things to him, his head's going to explode. I swear to God, his head will explode. I work full-time. Is this ideal for a person who works from 6 a.m. to 2 p.m.? All the lessons are recorded. So you can, we have a lot of people that sometimes just attend only the second session. They're all recorded. You can attend them later. You can post your questions in the chat. I'll answer them live in the next session. Yeah, you don't have to be there for every class to take a benefit from this. Yeah. Okay. I'm going to call it a session, everybody. Great session. Great questions. Great audience. Really good material. I hope you learned a lot. I think you did. I think we covered a lot of ground today. Whether you're beginning or experienced or whatever, I think you've probably learned a lot today, and there's just a lot more to learn. So I hope to be working with you soon. So Rodrigo, thank you for hosting this. It was awesome having you, and I appreciate it.
Appreciate you, Chris. Thanks.
I will see you guys next time. Take care, everyone.
All right. We'll see Chris in the school. Guys, I'm going to show you really quick the platform. If you have any questions, go ahead, post them. Good time to answer them. Thanks a lot to Chris for joining here. He's probably very tired because he does this every day, Monday to Friday. So let me just scroll back up here. So in the top, once you're logged in and everything, if you click video library, it'll take you where all of the recordings are. And that's what I've been scrolling here. Basically just going over the past sessions, you'll have full access to that. some of the chapters here: understanding option Greeks, introduction to options, market gamma, and how to build your own option strategies. We have a combining options with price action. So a lot of different strategies. Monica, yes, we do have a 7-day money back guarantee. So yeah, you can try it out for 7 days and see if you like it or not. All the lessons are there. So you can even go back to the, prior classes and just get a taste of it, right? Then if you go to the homepage, it'll just take you to a general homepage. You can look at the classes from here as well. But if you click live right here, all right, whenever there's classes, it'll take you straight to the live class with a chat room that is just for the lesson. So yeah, this is good for anybody that's working full time. Everything's recorded there. You have your chats. Let's go here. This is where Chris will post his trade ideas, right? So you guys have full access to this. He was talking about, all the stocks here today that he was writing down. You have different chat rooms here. Let's zoom in. All right. Student trade ideas, questions for Chris. We have a Q&A session after every class, general discussion, community support, class files for all the quizzes, right? And all of the trade ideas from Chris. Keep in mind, you also get pro, and you can do a lot of stuff with pro, right? A lot of you guys already know, but you can, for example, just look at live charts. Like, for example, I think I have a 50-day and a 9-day EMA. Let's take this off. See what's happening here with Peloton. Yeah, Sharon, it's for the year. Correct. So it covers all 4 semesters. So all of these charts that you're looking at right now in pro, these are live, right? They're not delayed. You will get full access to real-time data charts. And you can see this thing on the top. It says, why is it moving? And then Q earnings were like, these are all manual updates. We have somebody do that, like a department of people, that give you. So there's a full squad of people that actually keep all this stuff together, giving you all this data quick and easy. And it tells you exactly why it's moving. So you have a RSI, you can put EMA indicators, you can put a lot of things. This is one thing I wanted to show you guys. This is what I was doing this like behind, just looking at the chart. So I'm comparing this chart, comparing Peloton with GME. And I just found something interesting. Looks pretty similar, right? Let's get these dots off. All right. It looks very similar to the GME chart, I think. So you can do these comparisons, right? And you can pretty much kind of get a good understand. I mean, you can do a lot of research, right, in pro. This is something that I just noticed on the chart, and you can compare them, but you can see the little bumps there and everything there. But you have an insiders tool as well. In that insiders tool, you can see when there's multiple insider buys, all that stuff. Laura, yeah, you do get Benzinga Pro with the course. That's right. I mean, as long as you have the option school, you're going to have Benzinga Pro, right? So yes, everybody that gets the option school will have this, correct. So you can see multiple insider buys. We do scan SEC filings every day. We do have, technology that does that way. For example, here in PayPal, you can see the president and the CEO bought stock. Asana, that's a good stock. The president, the CEO, and the chair bought. So when there's multiple people buying stocks, insiders, this will let you know, right? And you can refresh this right there. You have this same concept, right? For insider purchases, insider selling above 100,000, penny stocks, like when there's insider buying on penny stocks as well. You get all that stuff. You get a calendar where you have FDA calendar, economic calendar, dividends, earnings, guidance. I use analyst upgrades as well. You can use this for that as well. You have the only pre-market scanner. right? Pre-market and aftermarket scanner. You do have it here. So that way you can set up your own scanners, right? And you can set it up here by 1 week, 1 month. And you can set the market cap, price, all that stuff. So all of this stuff you would get and more like this, the signals, you can capture price spikes, gaps, highs, lows, filter this by your watch list. What else? You can get Benzinga exclusives whenever we do, whenever Benzinga reports, whenever Benzinga does a PR, right, for a company, a publicly traded company, we do have that here, right? Like in a specific section, it's called Benzinga exclusives. Let me pull it up here. All you do is go here, categories, click exclusives, right? And then done. This is filtered by my watch list. So I do need a, right? So then you'll see basically the Benzinga exclusives and all that. It will be included. Somebody saying that Peloton is ripping. Is it? It's kind of moving. Yeah, it is moving. I mean, this is live, so you would know if this is moving right now. So when option school is over, then the access to Benzinga Pro ends. Yes, that is correct, Laura. As long as you have the option school, you will have Benzinga Pro. Monica, if you already have Pro, just reach out. I'll try to work something out with you. I'll leave my contact there in the chat and we could talk tomorrow. But yeah, no problem. That'll be fine. Okay, so let's see what else don't we miss here. Oh, you also have the squawk, right? So in the squawk, this is like from 7 a.m. to 7 p.m. We have somebody, Mr. Charlie. He's been doing this for a while here with Benzinga, and it's like a radio. Imagine a radio, but not like music. Instead, Charlie giving you breaking news that's happening in the markets. So, you know, like XYZ company announcing merger with this, or such company, you know, doing such acquisition. News that is moving the markets, right? Charlie will announce it there. You can have a lot of people have this actually from their, right now it's off. But basically he will be announcing, you know, certain types of breaking news, tradable, right? And a lot of people use this maybe when they're at work or when you're doing something else. Just put your headphones on, connect it, and your Pro will be running with this radio on, right? So you can do that too. There's one for options there, I see. You can look at block trades, halts, all that stuff. There's a lot that you can look in Pro, but this is good because you can actually use this to do research, find trade ideas, and then take that back to the option school and just chop it down with the rest of the students or with Chris as well, right? As you can see, he does pitch in as well with folks that have trade ideas and that sort of stuff. Deborah, the classes, let me pull this up. I know I have this somewhere. All right. All right, we're going to go over the syllabus just to show you guys the schedule. All right, so let's go to the top. Cool. All right, so Benzinga options, school syllabus. These are the chapters, right? Class 1, 2, 3, 4, 8 chapters. And there's also going to be bonus content, bonus material, bonus education, trade ideas, setups, all that stuff. That's, you know, we're not putting in the syllabus, but it's included. Introduction to options, Greeks, volatility, option strategies from single all the way to four-legged option strategies, combining those strategies with the price action and market gamma and how to build your own option strategies. So it's really broad. It will cover everything that you do need to pretty much know to be good with options in more than just one type of way. This is the schedule. So Monday to Thursday, Monday to Thursday, you go from 10 a.m. to 10:45. You have a lesson lecture. Then from 10:45 to 12, you have a lesson Q&A, right? Q&A for everybody, and current market examples. So you will be talking stocks. You will be talking markets as well. And then you have a break all the way from 3, and then from 3 to 4 p.m., you have a full lesson review, open market discussion, and this can sometimes be extended. It really depends on participation, if people have more questions, that kind of stuff. Chris does not mind really. So then on Friday, you go from 1 to 2 p.m., right? Friday from 1 to 2 p.m., you have class reviews and open student Q&A. So full open student Q&A, you review the entire week, the 4 chapters that you saw with Chris, right? Everything is live. And if you miss it, the recordings, I showed you where they are, you will get them. Everybody gets them, right? Plus the bonus content, plus the trade ideas, everything that we went over. So this would be the schedule. Everything is on Eastern time, Deborah. So even if you happen to miss it, you can still catch the recording. All right, now let me just go back. Let me switch back to the school here really quick, guys, just to show you the chat room from Chris. All right, no problem, Deborah. Sounds good, folks. So we went over some of the questions here. I left my contact. If anybody has other questions, I want to make sure that nobody's left behind here. This is something great we're doing, helping option traders. We're definitely saving at least one person from not blowing up their account, which is more than good enough for me. So right. So join the school, guys. Trade with the community. I'm going to leave the stream running here for a bit, but if you have questions, the contact is in the chat, folks. So thanks a lot for joining here. Thanks for working on your education, for being a part of the community here. We appreciate it, folks, and we'll see you next time.